Governments all over the world have orchestrated artificially low interest rates. They've done that a number of ways. And when interest rates are low, that makes people think, gee, it's not worthwhile saving, but it is worthwhile borrowing. Governments manipulating interest rates is always a disaster, even if for the short run, it can put you in a fool's paradise. But in the long run, which has arrived incidentally, it gives you a very real disaster.
Hey guys, welcome back to Library of Wealth. Today we have Doug Casey giving his opinion on the current status of the bear market. Casey says that the reason the stock markets have been doing well for the past few generations is because they are being driven by fake money created by governments for various political reasons. He is afraid we will experience a comeuppance, which will bring a lot of individual and corporate bankruptcies, as well as pension funds going under because their assets have crashed. And even though prices in most Western countries are high, you can't go to stock markets as they are overpriced, and bond markets are a triple threat to wealth because of the inflation, interest rate, and default risks. Let's check out this interview with Doug Casey as he gives his advice on where to invest your finances. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
The stock markets of the world have done really, really well for the last couple of generations. And a lot of it's been driven by phony money, fiat money, artificial credit, created out of nowhere by governments for political reasons. And I'm afraid we're going to have a comeuppance. And that will mean lots of bankruptcies, individual bankruptcies, corporate bankruptcies, pension funds that go under because their assets crash. Look, right now, prices are rising in most Western countries at 10 to 15% per year.
Yep.
Everything costs 10 to 15% more than it did at this time last year, being conservative. Now, how are you being compensated by that? 1%, 1.5%, 2%, or whatever like that. It's like a guaranteed loss of 8, 10, 15% per year. So where are you going to hide? Can't go in the stock market. Stock markets are still grossly overpriced. I'm not saying that there won't be a big bounce. I'm just saying that they still have a long way to fall. Can't go into the bond market. I mean, bonds are a triple threat to your wealth. You've got the inflation risk.
Why are bonds a triple threat?
Triple threat for three reasons. Number one is inflation, okay? The dollars those bonds are denominated in are losing value at the rate of 10 to 15% per year right now. So that's going in. Number two is the interest rate risk. Your bonds are what, 2, 3, 4%, whatever they are. But interest rates are probably going to go way above the current rate of inflation. I think they're headed back to 8, 10, 15% or more. And the current value of a bond fluctuates inversely with interest rates. So that's the second risk. And the third thing is the default risk. Now, of course, your government bond won't default because they'll just print up more money to pay it off. But corporations can default, in which case you get part or perhaps zero of what you put. So bonds are a triple threat to your financial well-being. You should sell your bonds tomorrow morning.
Casey says the issue with staying in cash is that banks have started treating your money as their own, and it has become hard to even get cash out of a bank. Going to a stock market is not smart because just as we are in a 40-year long bull market, we could also go into an extended terrible bear market. The problem with real estate is that it's built on a foundation of debt, and as interest rises, it becomes less possible to build or buy. Also, real estate is the easiest and most liable for it to be taxed by the government because it cannot be hidden.
Yeah, where can you run and hide? Let's look at the alternatives. You can stay in cash. Okay, maybe it's better to lose 5 or 10% per year, but still have the cash, assuming your bank gives it to you, which is another problem. Banks treat the money that you deposit with them today as kind of their money, not your money. And it can be hard even getting your money out of a bank these days. You can go into the stock market, but just as we've had a 40-year bull market, in many ways driven by artificial credit creation, I think we could have a long and nasty bear market. So I don't like that. Bonds, that's a kiss of death. So stay out of there. What about real estate? It's been very good to almost everybody for a long time.
Yeah.
The problem with real estate in most of the Western world is it's built on a foundation of debt. It's all borrowed money. Everybody, not everybody, most people have a mortgage on their house, and that includes commercial buildings and everything else. It's all built on debt. But as interest rates rise, it'll become less possible to build or to buy. And as interest rates go up, which they will, the price of a house fluctuates inversely with it. I mean, I could buy a $1 billion house if I had no interest rates and the mortgage extended for 1 million years. I could live in a $1 billion house. Okay, but if I'm paying 15% over 10 years, oh, well, I can't afford nearly as much, if you follow what I'm saying. So I'm afraid that real estate in general is kind of overpriced. And the other problem with real estate is it's the thing that is easiest and most liable to be taxed by the government. It's obvious, it can't be hidden. And it's something that only rich people have, or at least middle-class people. So that real estate's been very, very good to me in a lot of countries, but I'm not crazy about it anymore. So where are you going to run and hide at this point? Okay, it's really quite tough. This is why Richard Russell, some of your listeners may know who he is, or was, I should say, says that in a depression, everybody loses. The winner is just the person that loses the least. That's why they call it a depression, a period of time when most people's standard of living drops significantly. Okay, that's what we're going through right now. So what should you be doing? I'm telling you what you shouldn't do in danger areas. Well, I'm forced to the conclusion that if you want to preserve capital, even at $17.50 today or whatever it is, I'd say buying gold coins is the smartest way to save and put capital aside and just have it. It's money in its most basic form. It's the only financial asset that's not simultaneously somebody else's liability. And that's really important in an unstable world like today. So one thing is buy gold, secondarily, buy silver. Different investment entirely, but worthwhile considering in the same light. But I think that you have to try to be a speculator, which is not a good idea for most people. Most people equate that with gambling, or it turns into gambling for most people if they don't know what they're doing. But that's the world we live in. But let's say that when this thing is over, depending how stupid governments are, and there's a lot more stupid things they can do. Let's say it's over in 10 years, 20 years, 20. It's most of the real wealth in the world will still be here, most of it, barring World War III. And it'll just change ownership.
Casey continues by saying we are going into a period where everyone's standard of living will drop significantly, and that if you want to preserve capital, buying gold coins is the smartest way. He says gold coins are the best way to save and put capital aside, since it's the only financial asset that isn't someone else's liability, which is extremely important in today's unstable economy. Casey also advises people to try to be a speculator, which most people equate with or turn into gambling, when they don't really know what they're doing. Casey predicts that in the next 10 to 20 years, most of the real wealth in the world will still be here, it'll just have changed hands. What do you guys think about Doug Casey's advice on how to survive financially in this unstable economy? Let us know in the comments below. Guys, thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.